Principles of Finance with Excel Modeling, copyright Lou Gaddis. Topic 2, an introduction to capital budgeting. In this topic, we're going to apply NPV and IRR, that's net present value, and internal rate of return techniques to evaluate and select business investments or projects. We'll compute net income, straight line, accelerated depreciation, depreciation tax shields, salvage values, and free cash flows, build tables to do two-factor sensitivity analysis, use name ranges in Excel formulas, and actually create a user-defined function in VBA. Capital budgeting is a term used by finance professionals to describe the process for selecting investments. So, for example, you have 3 or 4 different investments you're thinking about undertaking, maybe launching a new business line or buying a new piece of equipment, and these cost resources today. How do you decide which ones you're going to do? The 2 main methods are net present value, where you estimate the cash flows, create a discount rate or a hurdle rate, a rate of return that you believe you require for that project. And as long as the NPV is greater than 0, that ensures that that discount rate or that required rate is being met. The other method, IRR, internal rate of return, is you specify the cash flows and you find that one discount rate that ensures the present value of all the cash flows is equal to 0. So in this case, you choose a hurdle rate. Say, I must return, say, 10% of my investments. And if your IRR is greater than 10%, you would accept the project. So those are the 2 main methods for evaluating projects. So let's calculate the NPV and IRR of these 2 projects. I'm going to grab the spreadsheet embedded into this PowerPoint. I'm going to copy that, click off of that, go to Excel, and paste it in. So we're going to use a discount rate of 8%. The cash flow today for Project A is $500, and then cash flows are specified here. And Project B costs also $500, and cash flows are specified here. So the question is, what project would we select? Well, we can use our NPV. We use our NPV function. It discounts all of these cash flows. So we'll specify a discount rate. I'm going to anchor that. And then we'll highlight all the cash flows starting in period 1. So remember, using the NPV function, you can only use it when that first cash flow starts 1 year from now or 1 period from now. I'm going to anchor that with F4 key. And then I'm also going to handle the first cash flow by subtracting the $500 there. Since it's already a negative, I'll just add it. So the NPV of the first project is $216. So we would accept that project. Now I can copy that formula there. And then I'm going to slide the cash flows over. So now the formula uses the cash flows of Project B, both 1 through 5 and 0. And you see this project also has a positive NPV. Now if you use an NPV to rank the projects, this one creates more value. So that would be the first ranked project, and this would be the second ranked project. So I would choose Project A. Now we can also calculate the IRR. I'll take the IRR of these investments. And it looks like the first one is 19.77%. Now let's remember what that 19.77% IRR means. If I were to plug in 19.77% as the discount rate and calculate NPV, that one would have an NPV of 0. Or if I were to plug in the 27.38 as a discount rate, the NPV of the second project is 0. So the IRR is that discount rate that ensures the NPV is 0. In other words, it's the rate of return you'll earn on your $500 investment. However, if I look at Project B, it looks like that has a higher IRR. So here's a situation where the NPV and IRR give conflicting rankings. This has the higher NPV. Project B has the higher IRR. Now, as a general rule, we're going to say anytime there's conflicts between NPV and IRR, we're going to use NPV. And the reason you can think about is, as a shareholder in this company or as an owner of this company, I care about cash and not return. So I want to maximize my wealth, not just my rate of return. So if there is a conflict, I would choose NPV. However, many firms like to look at the return you're actually getting, because NPV, it's hard to standardize across projects of different size. You know, maybe this one maybe costs twice as much as this one. So you want to compare the IRRs. Now we could just graph what these NPVs look like if we vary the discount rate. So let's just say vary the discount rate. Let's say the discount rate, it wasn't 8%, but it was, say, 3%. or 6%. So what I could do, I'm going to make that an input. I can look at a bunch of different discount rates, say 3% to 33%, and calculate the NPVs of project A and project B. So let me put in my NPV formula. Discount rate, I'm going to let that vary. Now I'm going to put a $ on E. That way when I copy it over to B, it stays in E. I'm sorry, copy it over to G, it stays in E. And then I'll put my cash flows. And again, when actually I'll just leave those the way they are. And then I'm going to add, whoops, I made a mistake there. You can see I should have only started with the cash flow in year 1. So what I'm going to add is that first cash flow there. So I have the NPV at 3% discount rate of these cash flows from 100 to 400 and the initial cash flow. So there's my NPV. Let me anchor all of these cash flows. And then I'm going to copy that here. And then look what I'm going to do. See, this formula, since it's anchored, stayed on project A, but I'm going to slide it over. So now I have the NPV of the second investment. Now I'm going to copy this down. And what we see, let me use some cell formats. That the NPV of project A turns negative when there's a discount rate of 21% and turns negative when there's a discount rate of 30% for project B. And I can graph these, and this gives you an idea what's going on with these conflicting answers. I'm going to insert a graph. And let me add a axis for my data. I'll do right click, select data, click on my horizontal axis, put in the discount rates, and hit OK, and hit OK. So what you see is the NPV for both projects is positive for low discount rates, and at some point there's a break even here. And we could run a solver to figure out what that break even is. But at some point there's a break even point that if the discount rate is 9% or less, it looks like project A is better. If the discount rate is about 9% or more, it looks like project B is the better project. And what's happening is project A is backloaded with cash flows. You know, they're getting bigger. And project B is front-loaded with cash flows. So when the discount rate gets really high on project A, it starts discounting these long-term cash flows, you know, at 20 and 30% for 5 years. So it really starts with the present value of these cash flows get lower and lower and lower. And it doesn't have as much effect on project B. That's what's happening, is that due to the timing of the cash flows of these two projects, depending on the discount rate, you'd get a different selection. Any discount rate less than about 9, I would go with project A, and anything above about 9, I'd go with project B. Next thing I want to talk about is just, we're not going to actually build this model, but say you bought a piece of land or a property for $100,000 years ago. However, it's only worth $90,000 today, and you're thinking about selling it. Now, if you just sell it today, you'll get $90,000. However, if you spend $20,000, it'll be worth $115,000, which is $25,000 more. So here's one thing you have to be careful when doing capital budgeting decisions. Only include incremental costs. Do not include any fixed cost, or I'm sorry, sunk cost. So for example, the way you don't want to do this is say, oh, should we fix that building? Because if we do this improvement on the building, I'll count for both the cost of my building and the repair. I'll say, well, the total cost is 120 and I'll sell it for 115. Oh, that looks like a negative 4% return. Well, that's not how you want to do it. You've already bought the building. So your only decision is whether you spend $20,000 today to get an incremental revenue or selling price of $25,000. So actually it does make sense to fix the building. So don't include these fixed costs, or I'm sorry, these sunk costs in the decision. Now let's talk about capital expenditures. A capital expenditure is an expenditure on an asset, say a machine or a tool or a building or automobile that's used by the business. And this tool or asset is going to have a longer than a 1 year life. So you're not going to expense it in, say, cost of goods sold or G&A or something other expense. What you're going to do is you're going to only recognize the cost of the asset over time. That's called amortizing or depreciating the asset. And that better reflects the profitability of the business over time. You know, say you buy a piece of equipment that's going to last 10 years, you'll just take, you'll recognize the some fraction of the cost each year, all right, to smooth out your income. So this is the basic idea of capital expenditures and depreciation. However, it does make things complicated related to tax, because even though depreciation is not a real expense, right? It's the recognition of a historical capital expenditure. It does have cash or tax consequences. And when we calculate cash flows, we do need to account for depreciation. All right, so what we're going to do is whenever we calculate cash flow, we're going to start with our after-tax net income. However, that after-tax net income has already subtracted depreciation, which is not a real expense. Again, it's just an accounting expense of a historical purchase. So then what we'll do is we'll add back depreciation because that was not a real expense in this income. Then we'll subtract out the actual capital expenditure when it occurred, the actual purchase of the equipment. And if we sell the equipment, we'll have to add some kind of after-tax salvage value or residual value. So if you buy a piece of equipment and sell it later for some surprise value or an unanticipated value, we'll count for that. So here's how we go. We're going to grab this example here of buying a condo. So this is a kind of a personal investment example. So I'm going to grab the spreadsheet, copy that, and I'm going to go to my Excel sheet. And I'm going to paste it. And now let me just even up the columns and make this look better. So in this example, you're going to buy a condo for $100,000. That's going to be my capital expenditure. And there's a tax rate of 30%. What I didn't copy over there is we're going to do a straight line. 10-year depreciation. That's what that asterisk should be for. So when we do our personal tax statements, what we're going to do is we're going to amortize the cost of this condo. Now we're going to make $24,000 in rent in the first year. We'll assume paid at the end of the first year, just for simplicity. Property taxes, $1,500, miscellaneous expenses, $1,000. Now the annual depreciation on your taxes, and this is true for a business too, well, we'll assume we'll do a straight line over 10 years. So we're going to amortize $10,000 of depreciation. So now your income before taxes, I'll sum this up. Is you have $11,500 in income before tax. I'll subtract out the taxes, 30% of that, $3,450. And then I'll take my earnings before tax or income before tax, subtract the taxes. So I made $8,500 reported net income. But that's not your cash flow, right? Especially if you're a small business owner or thinking about doing this on the side, right? You do not actually get a cash flow of $8,050. So let's start with that number though, $8,050. Whoops, not there. We'll make it right here. Now, in this expense, this is not the real expense at the end of the first year. At the end of the first year, this is, so the purchase of the equipment happened at the beginning of the first year. This is just for accounting purposes or tax purposes. So I'm going to add that back. So the actual cash flow at the end of the first year is $18,050. Now, my annual cash flows total is I'm going to actually spend $100,000 today. I'm then going to receive $18,050 at the end of each year. And then I'll copy that down. And in this case, we'll assume there's no residual value. All right, something happens and the building goes away, it never generates another cash flow. So let's calculate the NPV of that investment. We'll take a discount rate, say 12%, put in the cash flows, future cash flows, and then add the first cash flow, which is a negative. So NPV is at 1,987. And I can take an IRR of that investment and see that I'm making 12.48% return. Now again, if I were to put 12.48 here, the NPV would go to 0. That's the definition of the IRR. All right, so this is a very simplistic example of the fact that cash flows are not the same thing as net income. We have to add back depreciation, but they do have, depreciation has real cash flow effects because they save you in taxes. There's a tax shield. So we are going to then add the depreciation back and estimate the total cash flows and calculate an NPV. Now let's play with this one a little bit. Let's now assume that at the end of the 10th year, you believe you're going to sell now the asset for $80,000 as a salvage or terminal value or residual value. So you hear those terms a lot: salvage, residual, terminal value. So it's worth $80,000 at the end. Now, what you'd think I would do is just add $80,000 to this final cash flow, but I have to deal with taxes on this. There's a tax consequence of selling this asset, and namely the taxes on the sale of an asset that's being depreciated, a capital expenditure. The taxes I'll pay will be the tax rate times the difference between the salvage price, what you're going to sell it for, that's $80,000, and the book value. Now the book value is what it's currently worth on the balance sheet. So the book value is actually the purchase price. I paid $100,000, and every year I start depreciating that by, in this case, $10,000 a year. So it starts out at a book value of $100,000 on day one. It's down to $90,000 at the end of the first year and down to $80,000 at the end of the second. So the book value is going down to 0 by the end of the 10th year in this example. So in this case, my book value is 0 at the end of the 10th year. So if I take this example, and I'm going to add one more assumption, and that is I have a residual value. In year 10, at the end of year 10. I then have to add to my cash flow that residual payment minus the taxes. I'll take the tax rate times the difference between, the difference between that residual value and its book value. Now in this case, the asset's been fully depreciated, right? It was a $100,000 cost. I would then subtract all the accumulated depreciation, which is 10,000 times 10. So the book value in this case is 0. So let me look at my formula here. I take my normal 18,050. I'm going to add my $80,000. I'm then going to subtract the taxes, 30% on the sale price, $80,000 minus the book value. So I have $74,050. So now the fact that this property is going to be worth $80,000, I now am getting a 16% return, or a $20,000 NPV. Now on this property, let's do a little sensitivity analysis if we're thinking about doing this property. What if the rents are between, say you do an estimate or a range. I can make as little as $18,000 per year on rents, and maybe up to $28,000, going up by $2,000 a year. So maybe $18,000 or $2,000. I'm going to change that format. All right, now I can highlight those two, copy this over, and say I can make maybe as much as $28,000 per year in rent. And then what I could do, let me move this over one. I could vary, say, the residual. And so what's the property going to be worth in 10 years? It would say at the worst case it's worth $50,000. And at the best case, incrementing by 10,000, maybe it could be worth as much as $180,000. What I can then do is calculate all the combinations of, say, IRRs, varying the rents from 18 to 28 and the residual or the resale at 50 to 180. How I do that is I set up a table where I have one input and another input, and then whatever I want to calculate, say IRR or NPV, I'll just have a link to it right here. So this is a link to the actual calculation. Now the key is I'm then going to highlight this whole table, click on Data, what if, there's my what if. I do a data table. Now it says row input cell. In this case, my row are a bunch of rents. So I need to click on the original rent that ties to this formula, which then ties to this formula. And that's the key. This rent has to affect this number, which then affects this one. And then this residual value drives this number, which then drives this one. And there I go. I now have all the possible NPVs based on my assessment of the rents and residuals. So it looks like the NPVs will be between, say, 9 and 21%. With my base case, 1598, you should be able to see that number right here. So if rent is 24 and residual is 80, I'll earn 1598. Now we can also have some fun with this. It's hard to look at number data like this, so I like to add some color. So let's go to Formulas, or Home, Conditional Formatting. And we can add some color to this. I like green is good, red is bad. So it looks like the sweet spot is when you have high rents and high residuals. The low IRR is when you have low rents and low residuals. And this is my base case again. So sometimes I'll highlight that to show that it's my base case. All right, so now we've done some two-factor sensitivities using a data table. Added some colors. Let's do another example. Suppose we're going to buy a new machine. That new machine is going to generate some revenues and costs. So let's calculate the NPV of this project. put a new worksheet in there and size up the columns a little bit. So it looks like we're going to calculate NPV of this one. I'm going to have sales of 1,000. I'm going to subtract off cost of goods sold. I'm going to subtract off selling, general, and administrative expense. Now depreciation. This says it's an 8-year depreciable life of my capital expenditure of 800. So I'm going to put minus of my cost of my machine and divide by 8. So I'm going to depreciate $100 per year for 8 years. So that gives me a profit before tax of $200. Taxes, I'll take my 200, subtract that times the tax rate. Pay 880 in taxes. So now I have a profit after tax of 120. But again, that is not my cash flow. I'm going to start with 120, add back my depreciation, because that is not a real expense. I only needed to calculate taxes. So my actual cash flow at the end of the first period is 120. Oh, it's just 220. Now today I'm going to spend 800. I'm going to get 220 a year for the next 8 years. And if there was no salvage value, this would be my NPV. Put in my discount rate. However, and that looks like a good project. I can also do an IRR. 22% IRR. However, we're also going to assume that there's a surprise salvage value at the end of the 10th year. You realize, oh my goodness, we could sell this thing for $300. However, it's going to trigger a tax consequence. And remember from the last subject, if we're going to get $300 for this, the accumulated depreciation of this asset is going to be $100, and since we're looking at the end of 8 years, accumulated depreciation is 800. So that means the book value would be the cost minus the cumulative depreciation. So it actually has a book value of 0. So the cash flow from the sale of the equipment is I am going to receive $300. However, I'm going to pay taxes on the difference between 300 and its book value. So I'm going to pay taxes on the whole 300. So it's going to generate an after-tax cash flow of 180, even though I sold it for 300. I will add that to my initial cash flow, and then I get an NPV of 246 and an IRR of 23%. So you can see how important depreciation and salvage values are. So to summarize there, the salvage value after tax cash flow is the salvage value minus the tax on the sale. And the tax is the tax rate times the difference between the salvage value and the book value, where the book value is the initial cost minus the cumulative depreciation. And again, there's my solution. Now let's just take a slight variation of this problem. What if at the end of year 7 they wind up selling the asset? Maybe it's not working out too well and it's not worth that much. What would be the NPV if you had to sell it in year 7 for only $50? So we're going to make a few changes to this model. What if this is no longer the salvage value in year 8? What if it's the salvage value in year 7 and it's only $50? Well, we have to do some recalculation here. Let's assume the project now is going to end in year 7 and not 8, because you're going to get rid of this revenue generating asset. So I need to get rid of that. And now I'm going to calculate the salvage value in year 7. So I'm going to get $50, but now my accumulated depreciation, I've only depreciated 7 years of this asset. So the accumulative depreciation, the cumulative depreciation is $700 because I didn't get that last year of $100, which means the book value of the asset is $100. It's an $800 asset. The total depreciation is $700, so it's still worth $100 on the books. So when I sell it for $50, I'm actually going to show a loss of $50 in my accounting or tax statements. And therefore, when I calculate the cash flow from salvage, taking the salvage value, $50, minus the tax, minus 40% of the salvage minus book, I'm actually getting a tax shield. In other words, I only got 50 when I sold it, but it generates an after-tax cash flow of 70 because that $50 loss is going to shield other revenues, profits from paying taxes. So it actually is going to generate $50 from the sale plus an extra $20 in reduced tax savings. So that's what I'll add to my final year 7 cash flow. So now we have an NPV of 141. Now a little note. Examples in this topic and in this book assume the depreciation schedule is based on an expected 0 salvage value. Therefore, the full cost of the asset is depreciated. Now normally, if you remember back to a financial accounting class, if you know of a salvage value when you buy an asset, so you buy an asset for $800 and you think it's only going to be, if you think you'll sell it for $300 at the end, you would only depreciate $500, the difference between the expected salvage value and the cost. So for simplicity in this textbook, in this course in NPV problems, we're going to assume that all salvage values are surprises. In other words, when I say salvage value, you don't use this to set up the depreciation schedule. You just assume that, say, it's a surprise at the end, and therefore it triggers a tax event then. Otherwise, if you knew this all along, you would depreciate only the difference between 800 and 500, and then it would be a different calculation. So for simplicity's sake, we're going to amortize the entire amount and depreciate the entire amount, even if I say there's a salvage value or residual or resale value of a capital expenditure. So let's look at this little example. It's an interesting example because there's no revenue. It's just a cost. How do you calculate, how do you decide what to do when you're just choosing between two costs? So here's an example. Say I have a printer and it's kind of broken. So I need to fix it and then use it for another few more years. Or I can maybe just sell the printer and outsource all my printing. What do I do? So do I stay in-house and fix this thing, or do I sell it, generate a cash flow today, and then outsource it? So here's the solution, and we'll just copy this solution. I'll add a worksheet there, and let me make this easy to read. So here are my assumptions, my inputs, tax rate of 40%. I would have to spend $17,000 today to fix the copier. Now, for simplicity's sake, I'm going to assume the cost to fix the to fix this printer is not going to be amortized. All right. The lifespan of the fixed copier is 5 more years. So we fixed the copier for $17,000. It lasts for another 5 years. And it's going to cost another $25,000 in expense, say ink and other things to run the copier and paper. The book value of the copier is $15,000 today. At the end of the 5 years, the copier is then useless. We're depreciating $3,000 a year for the next 5 years on this copier still. But if we sold it today, we get $5,000. Now, if we sold it today, we would then outsource all our copying costs for $33,000 a year, and we're going to use a discount rate of 12%. So here's how I'd evaluate what we should do. So, and it's all about cash flows. If we fix the copier and stay in-house, we're going to spend $17,000 today. That's going to be an expense. However, that's going to create an expense. We're assuming we're expensing this, again, not amortizing this repair. So that's going to save us $6,800 in taxes by having this tax shield, the fact that you have an expense. It's going to reduce the total tax bill of the corporation. So after tax, it only costs $10,200 to fix it. Now, the in-house copy expenses are $25,000 a year. You have another $3,000 of depreciation of the machine. So you have $28,000 of expenses. I'll then calculate the cost or the tax on that. Remember, the tax is actually going to be a tax shield in this case because you're creating expense. So the after-tax profit or cost is only $16,000. We're going to add back the depreciation to get the cash flow. So years 1 through 5, it's only going to cost us $13,800 in cash to operate this machine in-house. Now, if we sell it, we'll get $5,000 today. That's what I said the resale value is today. We'll then calculate the tax. Say minus the tax rate times the resale minus the book. Now, this one has a book value of $15,000. So actually, it's going to show up as a loss. Right, we're going to sell it for $5,000, but it's still worth $15,000 on the books. So you're actually going to have a $10,000 loss on the sale. That's going to generate a tax savings of $4,000. So actually, you have a $9,000 cash flow from its sale. $5,000 from the sale, $4,000 from the tax shield. I'll then spend $33,000 a year outsourcing my printing. The after-tax cost with the tax shield of that expense is $19,800. There's no depreciation since we sold the equipment, so my cash flow is $19,800. So now I can calculate my NPVs. Let me even these out a little bit. If I stay in-house, here's my $10,200, and then there's my $13,800 for 5 years. If I outsource it, I'm going to generate $9,000 on sale, and then spend $19,800 outsourcing. I calculate the NPV of this cost that has a present value of cost of $59,000. If I go outsource, it's $62,000. So actually, this is a weird situation. If you're only talking about costs, the better solution is to have the one with the lowest cost. This has a present value of cost of $59,000, so I will actually do that. The net present value is higher. It's a lower negative number. Or I can take the difference. I say in-house minus outsourcing and take the NPV of the difference. And what you see is the NPV of the difference is $2,429. So it's better to do an in-house and fix the copier. Now, taking an NPV of a difference is the same thing as taking the difference of the NPVs. So in present value terms, we save $2,429 by staying in-house. So that's how you evaluate costs in capital budgeting. And let's do something with accelerated taxes. Let's grab the spreadsheet. Say your company is considering the purchase of a machine. And the machine is going to generate some amount of cash flows. We'll look at them in a minute. But you have a choice of what depreciation method to use. Add a worksheet, and I'll paste that. And again, I need to make things look a little better here.